financial markets. Last session, basically, we look into overview of international finance. We look at definition of international finance, the importance, the functions, some future career, opportunities available for you, and all that. We look into that. So today we are going to look at international financial markets. Um, since we are talking about multinational organizations, we are talking about uh, international business and international finance, so definitely it involves international financial markets. Okay, so an international financial market consists of international foreign exchange market, international money market, international credit market, international bond market, and of course, international stock markets. So in today's lecture, we will be briefly going through and trying to understand what does these exchanges does, this market does, or what are the functions of this market, how do these markets help international businesses and international trades. Okay, uh, let's begin with the foreign exchange market. The foreign exchange market is also known as forex. Forex, or sometimes we call it as FX in short, or even sometimes we call it currencies market, because here the currencies are traded. So it is basically an over-the-counter market, over-the-counter global marketplace that determines the exchange rate of currencies around the world. Okay, so this is a market where the currencies are basically bought and sold. When selling and buying of currencies takes place, meaning that you are exchanging the currencies, and when the question of exchanging the currencies comes in for the future, then the speculation also does arise. So you look into that. Okay, so you are looking at pair by pair. For example, the question of exchange only comes in when you exchange one currency with another, right? So foreign exchange market is where two exclusive currencies are exchanged. For example, if a Malaysian company is buying something or raw materials from Singapore, then the Malaysian ringgit and Singaporean dollar will get involved, and we'll have exchange of these currencies, right? So you are buying, you are selling, so that's how it is. So foreign exchange markets are made up of banks, forex dealers, commercial companies, central banks, investment management firms, hedge funds, retail forex dealers, and investors. So there are many market players in the foreign exchange markets. Okay. So what does the foreign exchange market does is basically allows for exchange of one currency for another, and exchange rate specifies the rate at which one currency can be exchanged for another, right? So here, basically, the exchange rate will be fixed. The exchange rate will be determined, not really fixed. And when two companies between two different countries, or even the same company having parent company in a country and subsidiaries in another country, when they get involved in dealing with one another, definitely the question of foreign exchange will come in. And that's where the foreign exchange market will facilitate in determining the rate of currencies that we exchange. Okay. So, in a simple sense, we say that the foreign exchange market is an over-the-counter marketplace that determines the exchange rate of global currencies, right? That's what it says. And it is by far the largest financial market in the world because every country gets involved with this, and it's comprised of a global network of financial centers that transact 24 hours a day, closing only on the weekends. Okay, so um, it is available, it's accessible for everyone to exchange the currencies at any time they want, 24 hours a day. That's how it works. Okay. So currencies are always traded in pairs, as we say. So the value of the one of the currency in that pair is relative to the value of another. So for example, like we look at US dollar and Malaysian ringgit now. So one US dollar equals about ringgit. That's how we look at pair by pair. So if you are getting involved in businesses with, say, for example, India, then we're looking at how much is the value of Malaysian ringgit with exchange of one rupees in India, right? One ringgit equals how many rupees? I think it's about close to 20 rupees now. So that's how we are looking at it. So we are saying the foreign exchange market helps in determining the value of foreign savings. It is a marketplace where foreign money is bought and sold, and we can also say it is a type of institutional arrangements where the foreign currencies are bought and sold. So even though it is an over-the-counter marketplace, but again, there are many rules, regulations are there, and that's what we say. It's an institutional arrangement. It's not like me and you go somewhere and we exchange our currencies as we want. It's not like that, right? We can just go to, as I mentioned last week class, you can just go to Google and you can find out foreign currency converter and you just put US dollar, one US dollar equals Malaysian ringgit. Then you will see the exchange rate is always there. So how does it determine? So that is something that we got to look at and ponder. So it's basically some institutional arrangements are there that determines the exchange rate of currencies. Again, we will be looking at later, possibly in session 4, the factors that contribute to the exchange rate determination of a country. We'll look into that later, okay? Now, an example, as I said earlier, but again, I'm giving you a written example here. Give me a 1 minute break. Just a minute. Okay. So, so it's a foreign exchange is a trading of one currency for another, right? So we give an example when you do a swap between US dollar and euro dollar, right? As I said, you are exchanging, you are doing a swap between Malaysian ringgit and Singaporean dollar. So that's how it is. Now, as I said earlier, we'll discuss more about exchange rates and floating the system of determining exchange rate in session 4. But again, I've given you a simple differences between fixed and floating interest or exchange rates. Certain country, the exchange rates are fixed, done by the government itself. We pegged it, like in Malaysia, 1999, the ringgit was pegged, again, US dollar. So a fixed exchange rate denotes a nominal exchange rate that is set firmly by a monetary authority with respect to the foreign currency or basket of foreign currencies. By contrast, a floating exchange rate is determined in the foreign exchange market depending on certain demand and supply. Okay, so it generally fluctuates. Um, is there someone trying to say something? Or I'm not sure why this sound is coming. Okay, I think Jane Sen has given you an attendance form. Kindly please fill in. Don't forget to fill in the attendance form in the Google form. He has given it already. So it's a fixed exchange rate would be fixed by an authority, right? Like in Malaysian case, the Malaysian Central Bank fixed it in 1999. Then after that, when the country economy became stable, it was withdrawn. But fixed floating exchange rate is depending on the demand and supply in the market. So it depends on the economic activities and many other factors that we'll be looking at later, possibly in session 4. Now, the history of foreign exchange. In 1876 to 1913, we had gold standard. The gold standard. So gold standards was a system under which nearly all countries fix their value of their currency in terms of a specific amount of gold or link their currency to that country which we did so. So the currency rate of a country was determined based on the gold that you have, the gold you have. So if you are having a certain amount of gold, and then we determine the value of the gold, and based on that, we compare with the other country and we fix the exchange rate. So international gold standard emerged in 1871 following its adoption by Germany. And in 1900 or 19th century, the majority of the developed nations were linked to the gold standard. So until the First World War, the gold standard was still there. It's still there. Um, Gold standard was somehow very good because there is no way of manipulating the exchange rates. No country could really get absolute advantage against other. Okay. Then it established, it abolished, unofficially somehow in um, 18, 1834 was established, but then it was officially somehow stopped using it in 1976, from where the US dollar got prominence and they started controlling over the world. So that's how it is. Um, if you want to talk about gold standard now, or you want to bring back the gold standard, you might be getting into trouble. So not many people will talk about it. People who spoke about it before, they had trouble. For example, like Saddam Hussein used to talk about it. He said he doesn't want to trade his petroleum with US dollar. He want to peg it with gold standard. Libyan President Muammar Gaddafi, he talks about gold standard, and you know what happened to him. So there are many international politics and things happen when it comes to international affairs, and many of us, we may not understand that. So US dollar being the dominant currency and being the currency of exchange now in the world, every single US dollar that is exchanged in any parts of the world, US government is making money. Okay, US government makes money. That's how it is. So when Malaysia is doing international trade and getting involved exchanging of millions of dollars, the US government is making already a lot of money. So it's a good business for them because US currency become the dominant currency in the world and they make huge amount of profit from there. So going back to the gold standard is not that easy unless US somehow loses its dominance over the world. Okay, that was the best time that we had. So no discrimination, no control over the country economy. Okay, so that's gold standard. Then in 1944, there was an agreement on fixed exchange rates. That's what is known as Bretton Woods Agreement, and system carrying collective international currency regime based on US dollar. So that's how it came into being, right? We tried to get away from US dollar. And in 1971, December, monetary authorities from the world's leading developed countries gathered in Washington, D.C. and ultimately all successful attempt to rescue the Bretton Woods global monetary system. Okay. So, so somehow the Britain agreement they had it did not really help. So the Bretton Woods Agreement was somehow uh, not really successful, right? So that's what we call Simtonian Agreement in 1971. That's how it is known. And then after that, the floating exchange rate came in. So this is what we have it now. So a floating exchange rate is a regime where currency price of a nation is set by foreign or forex market based on supply and demand related to other currencies. This is in contrast to the fixed exchange rate in which government entirely or predominantly determines the rate. So floating interest rate it is determined based on the floats, right? So based on um, your demand and your supply. So if there's more demand of your currencies, then your currency will get stronger. So you'll have more supply, you see. So if demand of your currency is less, then your currency value will be lower, as supply would be still there, right? So if you are doing a lot of trades, international business, your economy is stronger, your GDP is high, your remittance is high, you are getting a lot of foreign fixed foreign direct investment and all that, then it is expected that your currency will get stronger. So it is determined by the floating, by the float. So as economy gets moving, all the factors come together and they will determine what should be your exchange, your currency exchange rate against US dollar, as every country now follow US dollar as a standard currency to be exchanged with. Okay. So floating interest rate simply means that currencies exchange in the relative value all the time, right? All the time. For example, if one US dollar might buy £1 today, but it might only buy 0.95 pounds tomorrow. So the value floats. So if we go to online now and we see the exchange rate between US dollar and Malaysian ringgit, and then next week when we have the class and we look at the exchange rate, it will be totally different, okay? Because it floats. It can change anytime depending on the country situation. Anything happening in a country may immediately affect the exchange rate of your current country, okay?
Sir,
Yes.
sorry for disturbing. There are some students can't join this Google Meet.
Why?
I think because sir not using the faculty account, is it?
No, no, I'm using faculty account there, so all of you have joined without, I don't have to accept any of you, everyone on a,
Mm.
okay, I understand now, possibly because Google Meet has a limit of 100, is it?
Yeah, but if using faculty account, they can participate
Hmm,
more than hundreds.
okay, okay, okay,
So
I'm not using the faculty account now.
yeah. So we'll upload this video right later.
Yes, 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 yes.
Okay. Okay. Thank you, sir.
What happens actually, I wanted to use Webex, but then I changed my computer.
Okay.
I do not know, something went wrong. I forgot the password.
Okay. Never mind, sir. I tell them to watch the video later.
But it's not good because they want to join, they couldn't join. I thought because I didn't use the faculty account, so I
Mm.
cannot have more than 100. Sorry for that.
Never mind, sir.
Okay, okay. All right. So these are the some benefits that we have on the floating exchange. If you have floating exchange rate, so you say basically it provides some kind of stability in the balance of payment. Your foreign exchange is unrestricted. Market efficiency enhances because the market forces will work and it determines actually the demand and supply and later affect the exchange rates. Large foreign exchange reserves not required, import inflation protected, exposed to the volatility of exchange rate and restricted economic growth and development. So there are many benefits are there on the floating exchange rate rather than fixing it. Okay, because once you fix the exchange rate, you won't know whether your economy is getting better or not. Looking at the exchange rate, someone can foresee, someone can feel that whether your country is improving in terms of economy or not. Okay, so it's better to have floating exchange rate when economy is normal. But when you have economic crisis, that what Malaysia experienced in 1998, 1999 at that time, and the whole world at many times, right? 2011 also we had crisis. Uh, and I do not know what will happen after the uh, COVID is over, right? Most of the countries, they spend all the reserves during this difficult time. And we all know how countries will be getting back into normal. Uh, so we have to wait and see the measures taken by different government, finance ministries, central banks, and all, and how it's going to work it out. Okay, see if a country fail to manage the economy well, they may not have any choice rather than fixing it, all right, rather than keeping it floating. Okay, so it's better to have float, but if the economy is in turmoil, then we may have to fix it. Okay, now foreign exchange transaction. How does foreign exchange are transacted between countries? The most popular one definitely known as over-the-counter market. Okay, so what is an over-the-counter market? Over-the-counter market are those in which participants trade directly between two parties without the use of a central exchange or other third party, right? In Kangar, there's no foreign exchange counter, but there's a counter in Perlis, Kuala Perlis. I do not know whether they're still on. During the last 2 years, the business was not good, so temporarily they closed it. So I'm not sure whether they open it back again. The foreign currency over the counter, that was one OTC in Perlis. But if you go to Penang and KL or JB, those that are happening town, there could be dozens of foreign exchange over the counter anyway. So you just go and you exchange. Either you pay the ringgit and get back US dollar, or you pay the US dollar, you exchange with the Malaysian ringgit. Or even if you are traveling to Thailand, you just give the ringgit, they'll give you the Thai baht, right? So that's what we call open or over the counter market. So sometimes it may not have even a physical location because you may transfer it online. Huh? It may transfer it online. So if you are using online banking, it's possible for you even exchange the dollars, right? If you are making, say for example, when I publish a paper and I have to make a payment to Ukraine or say for example in Germany, uh, and I have to pay in their currency, I can definitely pay using my Maybank. Using Maybank online, I can still pay. Okay, so that is something not physical, right? Something not physical. I may not have to go. I can do it sitting in my home or office. So some of the products most commonly traded over the counter include the bonds, derivatives, structured products, even currencies, right? Even bonds, derivatives could be also bought and sold online over the counter. So an example of an over-the-counter market would be a trade that occurs between two individuals that buy and sell share of a company or is not listed in an exchange. If a company is listed in the exchange, then definitely you have to get involved with the stock exchange of a country. But if a company is not listed in the stock market, then they may trade their, you know, uh, they can trade by using the over-the-counter market for exchanging of the currencies. The next one, foreign exchange market. When you get involved in transactions of currencies, foreign exchange dealers basically serve as intermediaries. Okay, so financial intermediaries serve as middlemen for financial transactions, generally between banks and uh, funds, right? So you will always have some intermediaries. They work as a middleman in between the two parties which are transacting the currencies. Okay, so these intermediaries may help create efficient market and lower the cost of doing business. Intermediaries can even provide leasing and factoring services that do not accept deposit from public. And even the intermediaries may offer some benefits of pooling risks, reducing costs, and providing economies of scale, among others. So, say for example, if you are buying materials from another country, say for example, you are buying it from China, and it involves huge amount of transactions. and you do not feel very safe transacting personally. So there could be certain intermediaries, say for example, it could be a bank to do that, okay? So you'll have an intermediary, a middleman to help you doing the transaction. So you go through the bank, you go for banker's note, and there are many other ways of dealing with it, okay? Now, the third one is definitely the foreign exchange market. You may have a spot market, right? Transactions for immediate exchange and spot market. So we say that financial instrument trade for immediate delivery on the spot market. Many assets could be called spot price or future or forward price. So this is here a bit different from the over-the-counter market. Over-the-counter market is basically you are transacting immediately, but this is also one kind of spot over-the-counter market. But here the additional features are you can even trade the futures and forward okay, derivatives, which you have not been taught yet. So don't worry, we will be looking into it somewhere, I think session 5 or 6, the derivatives, okay? So don't worry. So you'll understand that futures and options forwards, those can be arranged, okay? So I'm not going to explain that today, but keep that in your mind. We'll be learning that later, okay? So this is how it is. This is basically an electronic market, and then we use the dollar as commonly accepted medium of exchange, and we follow different time zones. So uh, still, you will have opportunities of trading, right? If it is a future market, then you have to follow strictly the US market, New York Stock Exchange future market, okay? Uh, and definitely is anytime you exchange immediately, you get back the other currency that you want. So you're saying that the spot market may provide you more liquidity. Now, there are certain attributes of bank that provide foreign exchange. As I said earlier, there will be many intermediaries, especially the banking institutions. They may work as intermediaries. Here, there are some attributes of bank that may help the bank become efficient in providing foreign exchange. Number one, competitiveness of quote. When you would like to have transaction of foreign currencies due to international business, international trade, of course, you will look into different banks because you are transacting millions or billions of dollars. So you may choose the bank that give you the highest quote, right? So you're looking competitiveness of quote. Your special relationship with the bank, how fast they execute the transactions, um, whether they can advise you on the current market conditions and how it's going to work, and even they may provide some forecasting advice because organizations, they do not only make short-term decisions, they do make long-term decisions, especially when it comes to future and forward contracts. The companies will be making long-term decisions. So say, for example, today you are signing a deal with your supplier of another foreign country that you will be trading. Basically, uh, you are signing a deal basically to get the raw materials for next 10 years. Okay, but the deal is signed today, and you are signing it for 10 years. So you're making long-term decisions. In that case, the bank should be available to provide you some kind of forecasting advice. So which bank would be chosen? Depending on these five functions, there could be many other dimensions. These five are the most important one. The bank should be able to provide this kind of services to the client, the multinational organization that get involved in a business. Now, this is how we look at it. See, so when you look at banks and they give you the quotations, then that's what you look at, bid and ask rate. So this is what a bank will give you. So bid or ask spread, we calculate the ask rate minus bid rate divided by asking rate, right? So bidding is the bank, the rate they're going to give, and then you are asking for a rate, right? So ask rate minus bid rate, then the ask rate that gives you the spread. So that spread would be compared between different banks. Say, for example, Maybank has given you 4.1 and your asking rate is 4.2. Okay. And then, say, for example, Bank Rakyat has given another bid rates. So to make it easier, we'll calculate the bid or ask rate per dollar, and then we'll multiply the amount, the volume that we are going to trade. So that will tell us exactly which bank is more competitive. So we'll choose the bank gives you more benefits, right? Cost saving would be very important here. So the factors that affect this is spread, right? The bid and ask is spread. We are looking at order cost, inventory cost, competition, the volume, and currency risk. So the many factors is not only what they give me the bid rate and what I ask for. At the same time, we look at the capability of banks, right? Capability of banks. So those are the very important factors that we look at. Now, interpreting foreign exchange quotations. So see here, some examples are there. There could be direct quotation, there could be indirect quotation. For example, a direct quotation represents the value of foreign currency in dollar. So number of dollar per currency, like $1 equals 1.31 euro, right? 1 euro equals 1.31 dollar. That's how it is directly quoted. But if it's indirect quotation, it means the foreign currency per dollar. So we are saying uh, uh, 1.97 euro dollar equals $1. So if you are quoting as US dollar first as a standard currency, then it will be direct quotation. But if you are putting the other currency, say for example, Malaysian ringgit, if you put the quotation as 1 US dollar equals 4 ringgit, then it is a direct quotation. But if you put it as 4 ringgit equals 1 US dollar, this is an indirect quotation. Is that understood? Clear, right? If it's a direct quotation, then we'll put 1 US dollar equals 4 ringgit. This is direct quotation because US dollar is now a standard currency for exchange. And if I put 4 ringgit equals $1, then it's an indirect quotation. Is that clear?
Yes.
Okay. Then cross exchange rate is also there. Okay, exchange rate between two non-dollar currencies. So you are looking at one ringgit equals one say 1 US against ringgit, and then 1 euro currency against ringgit. So when you are having cross currency uh, requirement, the exchange rates, then you will have a good opportunity to see how it works. Huh? And that's how the US dollar makes money, because once you exchange your currency with US dollar, then that US dollar, euro dollar would be again exchanged with US dollar. So that's why US dollar is going to make money. And that's why I was saying anywhere, any single dollar being exchanged, the US government makes money. Now, this is what I will talk a bit today because we will have more discussion about it later. Basically, forward contracts is we agree on the exchange rate today, but the transaction will take place in the future. So the date is fixed, the price is fixed based on today's rate, but the transaction will take place in the future. It could be after 2 years, could be after 5 years. Okay, so that is called forward contracts. We sign a contract today, forward it for the future, right? The future date. So if $1 equals 4 ringgit today, and we agree on it, and the transaction takes place after 10 years, it's still $1 with 4 ringgit. But at that time, $1 could be 3 ringgit, or $1 could be 2 ringgit. We do not know. So this is a forward contract. So don't worry, we'll discuss more and we'll understand why companies tend to do that. Future contracts is we sign a deal today, but the price will be fixed when the transaction takes place. Okay. So today the two companies are signing a deal. Transaction take place after 5 years. So the price will be fixed based on after 5 years date, the spot rate. Okay. That's how it is. Future contracts. So the difference between forward contracts and future contract is both contracts are signed today. But for forward contract, the price is fixed based on today's price. Okay, but the transaction will take place in the future. But future contract, we agree to sign a deal today, but the price will be determined on the date of transaction. So it is after 5 years, it is based on after 5 years, the date of transaction. The price will be based on that date. Okay, that is a future contract. We do have also another one, we call it option contracts, whereby we do have, so the company do have a choice to proceed or not to proceed. Say, for example, a company signed a forward contract and they found uh, too much of variations of exchange rate and they're losing a lot of money, they may decide to cancel out. So you have a call option, you have a put option. You have to you have the right to buy the currency back. You have the right to sell the currency. Okay, on a specific time given as agreed. Okay, so even though you sign a deal on forward contracts and future contracts, again, we'll be looking at what are the terms and conditions been agreed. What are the terms and conditions been agreed? So if you have a terms condition there that anybody, if you sign a option contract, then you'll be given a specified rule there. If you don't agree, you can always pull back. You can cancel the contract. You may proceed, you may not proceed. So these are options you have. Okay. Now, so I think I did cover quite a lot on foreign exchange market. Let's move on to international money market. As we know, money market involves banking institutions whereby your transactions happen easily within a year. Okay. Since the corporation and governments in a particular country need for short-term fund denominated in a country currency different from another country. So I think basically it's a short-term funding, short-term funding. That's why corporation and government may involve. So the reason for international money market is need to borrow fund for to pay imports dominating the foreign country or borrowing currency in which interest rate is lower. So what we mean here is that, say for example, a Malaysian company uh, is opening up a branch in Indonesia. So if they want to borrow money from Malaysia and open up a branch in Indonesia become costly because of interest rate, inflation rate, and many other reasons, the company may decide to borrow it from Indonesian bank itself. It's a Malaysian company, but it's opening up a branch in Indonesia, so they decide to borrow fund from Indonesian bank. So that's where the money market, international money market, get involved. Okay, so we are taking advantage of having lower interest rate or lower inflation and all that, so it become beneficial uh, for the countries. Okay, so international money market. So you're moving, crossing the border, and taking advantage from other country banks for financing and investment purposes. So these are the two money market quite known. The first one is the Euro money market. You know that the European countries they join in one group and they have Euro currency. Uh, but 13 countries were there, right? So we say the dollar deposit in banks in Europe and other continents are called euro dollar or euro currency that we know. So this is the money market for borrowing and lending currencies here, the deposit of banks outside the country where they are legal tender. So among the 13 countries in Europe, since they have a common currency, so companies from one country can move to another country and decide to borrow or lend funds from those banks there. Okay, banks available there. So that somehow helps company to save a certain amount of money when it goes to investment and financing. Okay, and the second one is also quite known, Asian money market. This is an Asian dollar market by definition. So it's a regional market for euro dollars or uh, US dollars. It is basically located in Singapore, but is somehow also being dominated by Hong Kong. So these are the two giant business business partners dominating business countries in this part of the world. So you say it includes various euro dollar dominated financial instruments such as Asian bonds for long term loans and Asian dollar certificates of deposits. of medium-term maturity. So you have medium-term and long-term certain instruments that can be used to finance your businesses. Okay. So you're saying basically it provides an intermediation function between several Asian countries and euro market or euro currency market. So basically, this market help doing some kind of liaison works, right? It keeps some relationship with the euro market or euro currency market, and it facilitate the trades between Asian countries with the European countries. Okay, and the third one is known as international credit market. So it's a global market. Okay, classified into basically two markets. This is what we call international credit market or international market for the debt securities. Okay, uh, so here basically what we do here is we do have also international credit market as number one. It's called Euro credit market because there are 13 countries there and most of them are very developed economies. So the loans denominated in dollar and other currencies often matures in 5 years. Okay, so you are given the credit, uh, and then you run your organization. Say, for example, you issue bond, and you get the money, and you continue with your tradings. Okay, so the bonds usually will mature in 5 years. So we do use very commonly the LIBOR, Kuala Lumpur, sorry, London Interbank Offer Rate. So this is something the rate exchange between loan between banks of different countries. And we do have also CLIBOR, Kuala Lumpur Interbank Offer Rate. We do have that also. So in international credit market, here basically um, the money is available, the finance is available for companies to borrow. So there are different formats. It could be that the company issues bonds and they get money. The company gets some notes, right? They can have some other commercial paper like some arrangement of getting money, and then they run the business. Okay, and this is the fourth one, which is known as the bond market. So we say it is a market for bonds that are traded beyond national boundaries. So it is uh, most of the time we do have understanding of that the company can issue bonds into their country of origin, but actually we can now cross the border with globalization and advancement of technology. A Malaysian company can offer bond to Singaporeans. Malaysian company can offer the bonds to Indonesians, and raise the fund from there. It's possible now. Okay, so we are saying international bonds are bonds issued by a country or company that is not domestic for the investors. Okay, rather it is for the international participants. So it is a quickly expanding companies are continuing to look for cheapest way to borrow money. So say for example, if a Malaysian company issuing bond in Malaysia, possibly the coupon rate say about 5%. Say for example, but if they offer it in Indonesia, the coupon rate is 4%, or they issue it in China, the coupon rate is 3%. So you are looking at that. You quickly bring money and then raise fund with lower costs. So you are taking advantage of different country economic situations, all that. Okay. So here we segregated into two. Number one is the foreign bond. The other one we call it Euro bonds. So foreign bond is basically issued by borrower foreign to the country where bond is placed, and euro bond is sold in countries other than the country, okay, of the currency dominating the bond. So there are two categories again here, international bond. The first one is called foreign bonds. So uh, issued by foreign borrower foreign to the country, you see. So foreign bond is basically, say for example, if Singaporean country is coming and issuing bond in Malaysia, that is called a foreign bond. And when Malaysia company is issuing bond in Singapore, this is called Euro bond. Please do understand me. Euro bond doesn't mean it's an European bond. So foreign bond is when bonds coming from outside is being issued here and they raise fund for their business. So a Chinese company coming to Malaysia and issuing bond and raising fund, or a German company coming to Malaysia issuing bond and Malaysian buying the bond and the German company raising fund and they're paying the coupon rate and the principal amount at the end of maturity. But Eurobond, you are selling, say for example, Malaysian company is selling the bond in US and raising from there and running the business in Malaysia. That is called Eurobond. So they are two totally different things. Please don't misunderstand it. So these are the normal thing that we have in bonds. So I don't think I would like to discuss. And finally, uh, the last one is known as international stock markets. As you know, that uh, stock market in a country, basically, market players should be all domestic players, right? Like Kuala Lumpur Stock Exchange, Malaysian companies are listed, basically traded, and then participants in the market are also basically those resides in Malaysia most of the time. Of course, there could be some foreign participant also, but most of the time it's dominated by the local participants. But international stock market is basically we refer it to as international market that negotiate stocks from domestic companies. Okay, international market that negotiate stocks from domestic companies. Okay, so most countries have their own stock exchange. So the indexes track the fluctuations in the value of stocks of one market. So issuance of stock in the foreign market. So Malaysian company issuing stock in the foreign markets or issuing foreign stocks in the US. Okay, so there are two different things as I discussed earlier when I talk about the bond market, right? We talk about international bond or foreign bond and euro bond is something like that. You can issue stock in foreign market or you can issue foreign stock in the US, meaning that Malaysian company issuing stocks in US, okay, uh, you are issuing stock in other foreign markets. Okay, so we have different kind of arrangement there when it comes to this. So this is something to look at in a better way. I'm not sure whether you can see the slide properly. You can read. Let me see whether I can make it bigger. Okay. This is the impact of governance on the stock market participation and trading activity. So you're looking at how corporate decisions are made that determines, so you're looking at the governance, how a company is governed and how a company is run or administered. Okay. So you are looking at the stockholders or shareholders voting power. You are looking at shareholders' right. You are looking at strong security laws. You are looking at a low level of corporate corruption. You are looking at high level of financial disclosure. So you are looking at all corporate decisions, the policies are placed and how they are implemented. Okay. So when shareholders' voting power is good, shareholders' right are taken care of, that will contribute to managerial decisions which are intended to serve the stakeholders. Okay. And when your corporate corruption is low and a high level of disclosure is there, financial disclosure, that's where you will have the transparency of corporate financial condition. That will lead to greater investor participants and trading activity. So whether you and me would like to invest in the stock market or not, or whether you and me would like to invest in any international capital market or not, or whether foreign participants would like to come and invest in Malaysian stock market, or you would like to go out and invest in some other stock markets, are dependent on how corporate decisions, corporate sectors are run in a country. Okay, so we have few parameters here to look at. Right, we are looking at whether the shareholders are given enough right, they are given voting powers and all that. You are looking at whether you have enough security laws or not to make sure that you are not being victimized, you are not being, just taken a ride for free. For example, like it happens in my country many times. Even recently, it happens that a company goes on in the market and after some time they are no more there. They just took the money out of the country and they just run away from the country. So now living in Canada or US, a very happy life by exploiting, cheating hundreds of people or thousands of people in the country. So that's what happened in many countries. Okay. And you are looking at whether corruption is lower and whether the disclosure is higher. So this will all determine how manager decisions are made and the kind of transparencies you have. And that will actually influence you, motivate you, or inspire you for investing in the stock market, either domestically or internationally. And this is how foreign cash flow happens, because you have a parent company in a country and you have many subsidiaries. A Malaysian company may have subsidiary in Pakistan, may have a subsidiary in say, for example, in Nigeria. Okay, so you have many subsidiaries. Then how the cash flows between the subsidiaries. So here you can see how it happens. If you look at export and import, that's where the foreign business clients comes in. The export import happen, then you have a certain foreign subsidiaries, right? So you get the remittance coming in. You get the remittance coming in. So when you have export import and that will have the earning remittance and financing. Okay, so it goes to the subsidiary, right? From the parent company goes to the subsidiary. So when you have short-term investment financing, that's where the international money market comes in. Remember the banking institutions, when the borrowing or lending could be just 1 year, not more than that. And then you will have a short, medium-term financing. That's where the international credit market comes in. Okay, so you have certain credit organization give you the credit for medium term, right, 3 to 5 years. Or you may have long-term financing. That's why you'll be issuing stock. So it's an indefinite period. You do not know when you will be calling back the shares, right? It's for indefinite one. So this is a long-term one. So, and finally, you have the transactions, foreign exchange transactions there. So you have foreign exchange markets. So these are the few markets we talk about, right? Foreign exchange market, we look into international money market, international credit market, and then international stock markets, as well as international bond market. International bond market and credit markets are quite similar. So this is not shown here. So this is how the money comes in the subsidiaries, and the money also goes to the parent company. So if a multinational company is trading in more than one countries, that's how the trade flow will happen from parent company to subsidiaries, or the subsidiary to the parent company. Okay, so that's what I have prepared for you today. All right, so today's lesson was basically, if you still remember, today's lesson is on international uh, financial markets, a financial market that facilitates basically financing and investing activities of multinational organizations. Okay, and of course, beside multinationals, even individuals may get benefits of it if they want to. All right. Now, I would like to open up for question answers. So if anyone has a question, please raise it now. Did you get me what I tried to explain? Did you understand?
Yes, sir.
Was it very clear?
Yes.
It's
Yes,
one.
sir.
Yes, sir.
All right.
Yes, sir.
Anybody need any clarification on any point which you feel that was not adequately explained? No? All right. If it is very clear, then it's fine. But if you have any concerns or any queries, please.
Sir,
Yes.
are you will upload this note in the Google Classroom?
Um, all right. Last class, in your class, did I record? I did not, right? But the other class I recorded, so don't worry. That one would be, I'll put it, don't worry. So this one, this video I will share with uh, Senjen, is it?
Yes,
Senjen.
sir.
Okay, I will share the video with you,
Okay.
and then later please help me to share with your friends, can?
Okay. No problem, sir.
All right, so the slide, I'm going to share it with you now. I think the last week's slide I have given you all, right?
Yes, already given in the WhatsApp.
WhatsApp. So today I'm going to give you in the WhatsApp now, and the video the recording I will share with Senjen. Senjen, please do share your email address with me.
Okay. Yeah.
so that once the video is generated, I can email you. It takes some time to generate the videos, so you have to give some time. Don't expect it by before afternoon. And it takes some time also for me to download and then email upload. It takes some time. If I cannot do it today, I will try to do it tomorrow. Okay, so give me a little time. And the first week video will be uploaded in my YouTube channel by tomorrow. So I'll put it a premiere in the YouTube channel. If you want to listen one more time, you can listen to tomorrow at night. I'll put it in my YouTube channel. Okay. All right. Any other question? No.
Sir, are you will not make a Google Classroom for
Yes.
20?
Yes. 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 I will. I will.
Okay, okay.
All right. Is there any other question?
Sir,
Yes.
for international finance, we are not using any textbook, right?
No, no, we are using, you can use definitely. I will WhatsApp you. Sinjan also, please remind me today. I will WhatsApp you the book,
Okay, okay,
the,
okay.
the, the
Yes, sir.
cover page. Actually, you can use any international financial management book, but we prefer to use Madhura, Jeff Madhura.
Okay, sir.
I will WhatsApp him in the group, both groups, so that you can see the book. If you like to have it, you can have the book. For my class, if you strictly closely follow my lecture slides and class recording, that should be helpful. Should be quite adequate to learn the subjects and go for exam and doing all the assignments and projects. But still, for further understanding, more explanation and elaborations, you can always refer to the book. Okay. Um, As I said, you will be having one group assignment and one would be individual assignment. That's what you are going to do in the coursework. And then you will have final um, assessment. So your group assignment will be on fintech. Have you heard of it? Fintech, financial technology. Yeah? The one that is ruling the world now. All the digital marketing that you see, basically using fintech. So when you buy from Lazada or Shopee, or you are transferring fund through banks and all that, it's all using the fintech, financial technology, the latest technology that we have. So your group assignment will be there. Based on that, you just have to listen to. I do have a video in my YouTube channel, so you have to just listen to the video, and then if you require the slides, I will also provide you the slides. Based on that, you have to write a group assignments not more than 20 pages, not more than 20 pages. So if you make it 10, 15 pages, I'm still okay. So what I need you to do is please share with me your group member names, about 4 in a group, 4 to 5, not more than that. 5 is maximum, 5 is maximum. So you can have even 3 in a group, but 5 is maximum. So if you have 5, is fine even. So 5% in a group and do a group projects is a 30% mark. So I think about 20 pages will be more rational, about 20 pages. So 5% in a group. So I will share you the video link and then listen to the videos, and I will share you with the slides also. Then prepare the group projects with that. Is that okay?
Okay, sir.
So
Okay,
this one you have to submit somewhere. This is week 3. Give me somewhere in week 9. Week 9, Sinjin.
okay, sir.
Sinjin has to help me a bit, or
Okay,
reminding.
okay,
So week 9 will be the submission for group projects, and the individual projects. I will give you next week. Both of it will be. Oh, maybe I tell you this also today. Individual projects would be based on crowdfunding. Crowdfunding. There's another new emerging area. Not only new, and not actually new. It has been there for some time, but now getting prominence. Crowdfunding is when you raise fund from crowds. Say, for example, you open it up for anyone. You have a good business idea. You open up a business and to raise fund. You use crowdfunding, and there are many international platforms available where you can raise fund and you can do business. Okay, and there are very well regulated policies are there that helps you to make sure that people are not cheated. Okay, say for example, even if If, say, for example, your area is badly hit by floods, and you suddenly need, say, for example, 100,000 ringgit to help the people, you can actually use crowdfunding platform to raise it. So most of you do not know. So this would be a good opportunity for you to learn also. So this one also, I do have a video in my YouTube channel. You have to listen to that. And then you have to prepare individual assignment about 10 to 15 pages. And here I would like you to explain the Malaysian crowdfunding platforms. There are. So in my speech, I have given only the international crowdfunding platforms which you can use and raise fund. You can use billions of dollars and start up your business. But I would like you also to add on your own innovativeness and creativity by finding out the Malaysian crowdfunding platforms inside there. That would be your individual assignment, and that constitute 20% marks. Okay. So if I'll try to give it today, if not, then tomorrow I'll give you the link of both videos. Okay, so one is on fintech, financial technology. That would be a group projects, consist of 5% in a group. Or and the second one is the crowdfunding, which you have to do individual assignment. Okay, individual assignment, or maybe we devise a date. Individual assignment, you give me. This is week 3. Give me in week 7, and group projects give me in week 11. Would that be okay?
Okay, sir.
Week 7 and week 11. So crowdfunding, individual assignment giving goods week 7, and fintech group projects you have to give me in week 11, because I do have to mark. I have 230 students and I have to mark all that before I take the final assessment. So a lot of skips that I have to go through. So week 7 will be individual assignment and week 11 would be for group projects. All right. Any question before we end the class for today? All right. If no question, then you all take care. I see you next week at the same time.
Thank you, sir.
Okay.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you,
Thank
sir.
you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Okay.
Thank you,
See you next
sir.
week. Welcome. See you next week, inshallah.
Thank you, Prof.
Welcome.
Thank you.
Welcome.
Thank you.